There is a mutual fund for every dream, retirement, travel, buying a house, and whatnot. Some funds are safe as FD, while others are for people who are thrill loving, chasing high returns. Stay with us till the end. We will discuss about each of them in detail. Hi everyone, welcome back to Financial Mindset. In this video, we will discuss different types of mutual fund. Mutual fund come in many types, but they all revolve around three big questions, which are: where is the money invested? Can I enter and exit anytime? And finally, do I want growth or income from it? Like a single cloth does not fit everyone, similarly, not every mutual fund is built for everyone. Before investing in a mutual fund, we need to look if it meets our investment goals or not. We can broadly classify them on the basis of active and passive funds. Active funds are those funds in which fund manager uses his own experience and strategy to invest the amount, but in the passive fund, the fund manager just copies the market index. Then we further classify them based on asset class, structure, investment goals, and lastly, other types. So the first one is equity mutual fund. These are the risk takers. These funds invest in shares of companies and act as accelerator of our wealth. But they involve risk as they completely depend on how the market performs. These funds are best for those who can tolerate market drama, or we can say ups and downs. Mostly investors who have long-term goals invest in these funds as they help to create wealth in long term. Now comes the low risk, low return funds or the debt funds. These invest in government bonds, treasury bills or corporate debentures. These funds are for those who hate surprises and want low but stable returns with lesser risks. It's our human tendency to search for balance between two extremes. For investors who seek balance between equity and debt funds, there are hybrid funds. These are the blend of both, which means they invest in both equity like shares and debt like government bonds, etc. Moving forward, we will discuss the funds based on their structure. So the first one is the open-ended funds. These funds provide free entry and exit. We can buy or sell units anytime based on the net asset value. We will discuss about net asset value in the upcoming videos. These funds are for those who want flexibility in investing and redeeming the amount. Now comes the close-ended funds. In these funds, we can only invest during the new fund offer period. After the NFO, these funds are locked for 3 to 5 years. We can't redeem them until maturity. Although there is one catch, these funds usually get listed on the stock exchanges, so we can sell them to other investors in some cases. So the next one is ELSS or equity linked savings scheme, or we say tax saver funds. These helps to get 1.5 lakh tax deduction under section 80C in the old tax regime. These funds also have 3 years lock-in period during which we can't redeem our money. But in new tax regime we don't get any tax deduction using this fund as section 80C does not apply in the new tax regime. Next are funds based on investment goals. So the first in this category are growth funds. In these funds we don't get any dividends as earnings are reinvested into the fund. These are best for those investors who don't need regular income and want to get the benefit of compounding. Next one is the income fund. These are also called income distribution cum capital funds. These are for those investors who want regular income either monthly, quarterly or annually. Basically, these are opposite of growth funds. But keep one more thing in mind that the regular payouts affect the NAV. Moving forward, we have the liquid fund. So when we want to park our money somewhere before investing into the main fund, we use the liquid funds. So these funds basically have minimum risk and high liquidity with low returns. Now we will discuss some other popular funds which don't fall into these categories, like goal oriented funds. These funds are designed for specific purposes like retirement funds and children education funds. These basically have investment strategies which suit to the specific goal. Finally, the last one is the index fund or the passive fund. They basically copy a market index like Nifty 50, Sensex, Nifty Midcap 150, etc. Fund managers just try to match the market by copying the index. Last but not the least, one bonus fund, which is the ETF or exchange traded funds. Basically, these are the combination of mutual fund and stocks. They pool investors' money to invest into a group of shares as well as they trade like shares. We can buy and sell them during the market hours at live prices. Mostly ETF also tracks some or the other index. So this was all about basics of different types of mutual funds. For more such videos, do like, subscribe and share. This video is only for educational purposes. Any information provided in this video is not to be assumed as an investment advice. Characters in this video are completely fictional. Please consult a professional before investing.